One of the big things that a lot of people talk about during a recession is whether or not it's the best time to invest. What's your impressions of it? I know, Mark, you're kind of, if the deals come now, or...
I couldn't agree, well, I couldn't agree more, and it's only, I was telling someone this earlier tonight, I almost am embarrassed to say that the worse the downturn is, the better the opportunities look in terms of quantity and quality. And I think it's a function of a number of things. One is, there's a number of funds in Southern California, but not nearly as many as the Valley. A lot of the funds that are in Southern California are out of money, as an example. We've been out for a while, so people know of us. There's a lot of people that their budgets are getting whacked inside of big corporate America, so they're frustrated, so they leave. There's folks that leave involuntarily. There's a lot of startups out there, labor, so to speak, comes down, valuations of startups come down. And if you look at the historical data, statistically, some of the biggest at least in the tech companies, perform during really downturn in the economy.
Yeah. Stu, what's your perspective on this? It's a downturn. You've just launched iChange.com. Your last company was during a downturn too, in 2003. No?
I couldn't agree with Mark more. I think this is from both sides. I think this is the time as an investor to get good deals for all the reasons he's saying. I like this time as an entrepreneur also, and I think it's coincidental that maybe I do have some foresight here about starting companies during downturns. But I think this is a time where competitors are struggling, access to capital is limited. If you can get customers now, you can certainly get customers when times are good. So if you can get traction now, you're golden. You are really golden. So the question is, the reason we're all here talking is, can you get the capital you need in this kind of environment? And the VC climate right now is really tough right now for an entrepreneur. We're talking about stories about raising money. These are having Sequoia come in and tell me they want to give me an offer is a pretty rare story. Sequoia's still invested, but you don't hear many stories like that. Now is as hard as it's ever been in my career to raise money. So I would say absolutely now is the time to start if, and we can talk about this, if you can get access to the capital you need to build.
What's the best way to get access to capital?
Don't go to the VCs. That's a sort of a flippant answer because we're all VCs sitting up here, but in many ways, it depends. But one thing I would say, and I see this from a lot of entrepreneurs, a lot of people seem to think that VC capital is an end in and of itself. And I'd be really careful about that sort of thinking. In fact, I would actually think of the venture dollars for an early stage company as the dollars of last resort. After revenues, after putting my own money at risk, after raising money from friends and family, after angel investing, right? VC is, I don't know how many, 4. VC is 5 at the highest. And so it really depends on the company. But VCs, while they can bring a lot of good, especially if you get a smart VC that can add sort of strategic value and insights in your business, and Intel is a perfect example of someone like that.
Bottom line, venture capitalists will kill babies.
Venture capital will kill babies. Venture capital will sit on your board. They'll have possibly a different perspective about what you want to do, what you should do in your business. They will possibly weed you out if you're not performing the way you want. They will dilute you. They will possibly put you in subordinate positions on the cap table. They'll do, there's a lot of great things that come from VCs, but there's a lot of things that entrepreneurs should know about before they make that first call and talk to VCs.
Mark, I saw you nodding, but...
yeah, it sounds, I used to make fun of attorneys because I was one, and now I'm a VC, I get to make fun of VCs. Man, what an industry. The reality is they have fiduciary duties, or we have fiduciary duties to our limited partners, and it goes to making money. We're not a community bank. We're not there to start as many companies as possible. Our job is to make as much money as possible in a short amount of time. Funds tend to be 10-year vehicles with a 5-year investment period, allowing for liquidity from years 3 through, heaven forbid, you go past that 10th year and have to get an extension. But you're looking for outsized returns that outperform public markets, outperform other alternative asset classes, and it's an investment game, plain and simple. Now, how you actually create value differs depending on whether you're at the early stage or the late stage. And so speaking for us, we invest at the early stages. We're literally rolling up our sleeves. In some cases, we're initial or interim CEO. We, whether we provide legal advice, HR advice, whatever the advice is, introductions, access to the first set of customers, all of that is part of it. But at the end of the day, we're there to make money. And
You wouldn't know it from venture capital average returns that their goal is to make money. Over the past 10 years, they've kind of netted out at about zero.
It's probably worse than that.
Yeah, you would have been better off putting your money under a mattress. What's with the bad returns?
It's not true, but it's, if you look at the Thomson financials, obviously, I guess it depends on which period you're looking at, 1, 3, 5, 10, or 20, which venture capital is always looking at 10, 20 plus type time horizons. Their numbers are still better than anywhere else.
Yeah.
So it's a relative thing.
I could still run fast if I were in college.
Yeah, exactly. I think it's a number of things. I think it's a number of your VCs complaining there's too much capital, chasing too few good ideas. And I don't think it's that. I mean, I think there's a lot of capital. There's other sources of capital. I think access to capital has changed over the years. The fund dynamics themselves have changed. When I came out, the first thing I did is I contacted people to decide whether I wanted to do this. I talked to Don Valentine at Sequoia and John Doerr at Kleiner Perkins, two of the luminaries in the industry, had access to them, took my call, hey, let's set up a meeting, met with them. They said the same thing. The industry's changed as we know it and is growing into this larger later or this club deal back to the origins of the industry. Talked to Marc at the NVCA and he said, well, it's a barbell effect. You're seeing funds either being forced to be small and regional or large, multinational, almost private equity-ish. And I think what's happened is you're forced to choose between the two. And if you're a fund sitting on billions of dollars, it's really hard for you to invest $100,000 into a company,
Sure.
Yet they want to do it.
Yeah, Eghosa, you're a fund that's sitting on several $1 billion, but you don't have any trouble writing $100,000 checks, do you?
No, they're strategic, it's different.
Tell us how that's different.
Well, I think the one thing that Intel has so the clear value proposition Intel looks at when we're investing in companies is that we've never sort of assumed that we're going to deliver, we're going to solve world hunger, right? We've sort of looked at everything, what we're participating in an ecosystem, which means that you have to have a lot of people going in the right direction, in the same direction generally. And so what we use Intel Capital for is a vehicle to see activity in the ecosystem. Now, we're a little bit different from your VC fund because we don't necessarily have a timeline. We don't have this artificial 10-year construct about we have to reach $100. We actually have a portfolio company that we invested in 1993. It's still in the portfolio. We continue to invest in it. It's probably going to be the biggest IPO I think this year if it's going to come out. That's what.
And for those at home, what's the name of that company?
If I have to tell you that,
Just watch the S1s, you'll figure it out soon enough.
but that's what we really look to do is we know innovation continues to be important. We know, and I don't usually like to get into the propaganda, but we also know that entrepreneurs have a lot of value to add in any economy. Right? And so, you saw what we announced today.
What about venture capitalists? Do they have any value to add in the economy?
Some.
Some do. I've seen a variety of VCs, and I'll be candid. I have this philosophy about venture capital, working hard. But there's also a philosophy which is that I'm not front and center, right? I mean, where I come from, I'm Nigerian, and we have a king where I come from. And what's fascinating, which I've always admired, is that when the king dies, there's this selection process. And the Council of Kingmakers, actually most people don't know who they are. Right? And it's an interesting and subtle theme because even with all that power, you're not allowed to exercise that power. Right? And that, I think, is where VCs need to be. But a lot of them get stuck on themselves, get stuck on the money they made, and then, and so what you really want to do is to
come and talk on panels.
This is called deal sourcing. But so from our perspective, we want to continue to encourage entrepreneurs. Not every entrepreneur's business, honestly, is ideal for VC. That's the bottom line.
Most aren't.
You know, and so it's okay to accept that, right? It's not, you know, I think to Stu's point, you know, you will find some deals that are, you know, and FedEx had a hard time.
Yeah, sure.
You know, I mean, there are lots of examples of companies that had a really, really hard time. Despite what you hear about Google, they had a hard time because they were the 14th search engine. So, yeah, revisionist history and all that aside. So I think really what you really have to do when you're looking at venture and looking at sources of dollars is, you know, look first of all inwards. You know, get as many people. What's that classic rule? When you're looking for advice, you'll get money. And when you're looking for money, you'll get advice. Right? And going out there to really ping people to say, you know, does this thing make sense? You know, now, there's also trust in your own instincts. And if you fail, that's fine. You fall 7 times, you get up 8. But what you want to do is make sure that you have a relatively good 360 view about your opportunity, why it's going to make sense, why it's going to matter.
Sure.
That's just the bottom line.
Sure. Stu, you've worked with plenty of venture capitalists, some of which are very well known and like to be out front and center. How do they add value to companies?
I'd say it varies widely. And if you're ever in a venture capital pitch, you will hear these words: "We are smart money," and you always smile and you nod your head and you agree.
It's another value add.
Right. We're value add. Come on, I mean, your money's value add. That is absolutely for sure. VCs can't be value add. I mean, first and foremost, you're out raising money, raise money. Secondly, if you can find a VC that you think can be helpful, VCs can be extremely helpful, but there's a couple of forces you need to work around to make that happen. One is when you're raising money, don't just look at the VC, look at the partner who's leading the deal, because that partner will be your board member, that partner will be your sponsor, that partner will be fighting for you, defending you at his partner meetings when you need that next round of capital. That partner will be on the phone helping you with business development relations, hopefully will be helping you hire. And then that partner in that firm becomes your partner, and that partner is probably sitting on 6 other boards too. You need to really diligence this person as hard as they're going to diligence you. I mean, they're going to call, if you've ever raised money, you know that they will call your references going back many years to find out what kind of person you are. You should do the exact same thing with the VCs you're working for. And a good VC will add a ton of value. Sequoia was tremendous, and Roelof especially was he helped me recruit top people. He helped me get into Google, which nobody was able to do at the time doing what we're doing. He helped me do a lot of things, but I think someone like that is top tier, but again, you should be interviewing your VC as much as they're interviewing you.
Yeah, so that's a good thing to keep in mind.